This afternoon, we talk about estate planning. We talk about trust. We talk about why someone would even want to set up a trust. So with that topic, let's just kind of, in general, talk about what we know in reality. So we watch news every day, and on the news, sometimes you hear people talking about who and who has so much died suddenly and have so much asset there, and how their family are battling over the asset. And those are typical reasons why you don't want to leave your wealth to your family and creating that kind of battle. So those are the things, these are the things we, often hear, but a lot of time folks don't want to relate that to themselves. And I will have to say that in the small business world, there's more and more millionaires, people with money coming out of the woodworks than ever. If you talk about 40 years ago, people become millionaire, making a big success of a business, it takes generations. But nowadays, you and me, we all know that people could become wealthy really fast. And with this kind of tendency, you got more millionaires, more billionaires out there. You, as a small business, you might just be one of those who had worked so hard and built your fortune. And then now you are having a lot of money on hand. And yes, your mom and dad didn't tell you what to do when you have so much money, because they were poor and you were brought up poor, and you do not have that kind of language or that kind of understanding. But with community CPA, we are people who coming from nothing to where we are today, including myself included, right? I am an immigrant and from Canada to US, but before that, I was an immigrant from China to Canada. So with this path coming to United States, and I understand that I didn't have money and I didn't really need to understand anything about estate. And in fact, English is my second language. If you tell me about estate 30 years ago, I would have a blank stare at you and going, I don't know what you're talking about. So a lot of you are that way. A lot of my followers in our channel is that way because we all have a specific growth path. We just arrived here. We just arrived in the place where we look at the creation we had from the past. We want to leave that legacy for our kids, our children, our community, and we want to preserve our wealth. So you are here to listen about estate planning, about why do I need to establish a trust. So let's get going on that. Before I do that, I am going to share a screen with you, and so we can guide our conversation in the organized way. And I don't exactly go through the slides words by words, but the way I am doing it, it helping me to see where I am and to guide my thoughts so I don't digress in terms of knowledge sharing. Obviously, I can be here talk for a very long time, but I want to be more focused. What you are looking at right now, folks, is actually our website. Whenever you have some needs, you can go to appointment button, and in here, you actually will look at the partners in our firm. We are a pretty young firm, and those partners you see on the list, they're young, but they're not young, and they worked here for more than 10 years. Does that make sense? We build community CPA together. So these are not people who are just young being young. They are young in starting their career, so they're pretty extraordinary. And with this team, you can actually click me and to get on my calendar by knowing what's available and the time. So this is how you get hold of us. And then the other way to really collect the knowledge that we shared here is to know our YouTube channel. If you have not subscribed to it, subscribe to it, because that channel, we are not entertainers. So, if you don't have a needs, our talk can be boring. But if you have a burning desire to know, oh, someone was talking about trust, and I want to set up a trust. I just don't know why. And who can do the trust? Do I go to community CPA? What's the difference between having a trust with a community CPA or versus having the trust established with this attorney that I just get to know? What's the difference, right? Those are the questions you need to get answered before you move forward. And we are here to resolve that for you. This channel is actually a place where you can get a lot of these answers. Our channel is actually designed to be do-it-yourself channel. So we call it do-it-yourself because we don't really, it's not the channel that we are purposefully advertising ourselves so you can come to work with us. No. Our number one goal is to knowledge sharing. Our number one goal is to share knowledge in such a way that it is plain in English, is matter of fact, and there is no marketing tricks in here. We just want you to learn it, do it. If you can do it yourself, amazing. If you can't, you have us. So establish a trust and why, right? And I will quickly go through a couple of slides here. This is about our firm, and I really want you to know that we probably the only professional firm open 6 days a week, Monday to Saturday. So if you're so busy, you can probably still spare Saturday to come to visit us. We have been that way since our establishment inception. It's not like we just do that during the tax season. And we do speak many languages among our staff, and more than 10 different languages are spoken inside of our firm. And I myself served with at the federal level called National Taxpayer Advocacy Panel, an advisory committee to IRS. So with my credentials, and one more thing I want to mention is about the 2 books I wrote so far. I am writing the 2 p.m. right now. So the first book is Appointment Within at 8 a.m. The second one is 10 a.m. I am illustrating a business process from 8 a.m. beginning, starting a business, 10 you grow, 2 p.m. you expand, 6 p.m. you retire or repurpose your life. That's what I call it. So I have those 4 books in the, in my warehouse. I want to write them, and I finished the 2. I still have 2 to go. And the no responsibility disclaimer so required to put that out there for you to be aware that information you grab from internet, information you got from our free YouTube channel are just for your reference, and make decision based on your condition. If you ever not clear of what we're talking about, contact us, and maybe something we said is not right, you felt like you needed clarification. If you just call the firm, goes, I think something you said is not right on YouTube channel, I want to talk to you, get a clarification, we'll come on to you. And of course, we come on to you for free because we want to make sure we provide quality service here. All right, so my first slides, and I want to ask you this question because I know you ask that question to yourself all the time. You have no estate planning, you have no trust, you didn't do anything, but you die suddenly, what happened? And this is the question often asked us to ourselves, because we don't really have an answer. So we think in that way, what happened? People die suddenly all the time, folks, right? This is not something I make up, you make up. It is the fact. So if that ever happened to you, I just want you to know what happened on the estate side. So your asset, your belongings will be distributed according to intestacy law in your state. So depends on which state you are, there is a law for someone die without a will. They call that intestate. Died without a will is die intestate. So in that case, the government, the state government makes that call for you. Okay, you die without a will, and then that will be that happens all the time. So they know who is your spouse, they know who is your children, so they just gonna go with the state law. But typically, of course, your belongings goes to your closest person, right? If you have a spouse, it goes to your spouse. But what if you are one of those just before you die and you made a decision to divorce your spouse without a estate planning, without a trust, and you actually let the state make a decision, just giving everything to the spouse that you are about to divorce. You just didn't have enough earth time to do it. Because they don't have a record of your filing divorce. So there's no question about it. It's just going to go to the closest person to you. Without a will or estate planning document, there may be uncertainty that you cannot imagine. I will tell you one of our case, one of the case that I know. And what happened is the parent died. The kids are all in their 60, 70 years old already. But the parent died without a will. And so those adults, more than adult children, am I right? They're much older people. And they would fight over a crystal vase because it has a sentimental value. So do they really care about that? They are not caring about the money. They're just caring about the sentimental values in that flower vase, and they wanted it. So they want from their parents. The parents died, so each one of them, there four of them, so they all want it. So for that, they went to court. So I'll just tell you that, the court cannot decide on that either. What do they do? Break that into 4 pieces so each one of them have one. And it is just bringing a lot of trouble. And the famous people who died without will, I have 2 musicians, which you know them, and Jimi Hendrix and Michael Jackson. Remember them? And Jimi Hendrix is the guy that literally invented electric guitar. And he died suddenly in the 70s. And his estate battle lasted 30 years, just got resolved in the 90s. And then Michael Jackson, this is the most recent, 2009, he died. And his mother filed in the court saying that he has no will. That means if he died without a will, and then everything would go to his mom and his children, right? So California will make the decision on that. And then later on, of course, they found the will, and then the mother is in court fighting with the estate. So this is where the planning wasn't done. The planning wasn't complete, and it wasn't properly administrated to really ease the afterlife. And you just want to understand that if you don't have anything and there's nothing to worry, but if you had made a good business, you made some money, if you don't do your trust, you don't do the planning, and you are being irresponsible to the people who are taking care of you after your death. So what is estate, folks? And I have people ask me that question. The estate is a word. This word actually means a piece of land that owned by someone. So especially after you die, that piece of land you own is called estate. But in a lot of ways, estate representing after you die, everything that belongs to you, right? And it is hard for an immigrant coming from the non-developed country, they never had anything. When they come to US, they make money, they have a good life. So they actually have estate, but they do not really learn that and see that from their parents, or maybe your parents were not were not wealthy enough that it was never an issue. And you know that with the estate, and typically you learn those kind of concept, you understand the way how things should be done if your parents are practicing that. So in business is the same way, right? When you get into a business, if your parents is already running business, and when you run it, it will be a lot more understandable to you. All of these things were talked about on the dinner table, you know them. But not if this is not a situation with your parents' home, then you have this situation you need to learn. Most of the immigrants do not understand the concept of estate and have very little idea about what to do, or they don't think of what happened if they die. So estate has two big parts, and I want you to kind of, if you close your eyes, someone asks you, what do you do with your estate? And I want you to think of two things. Number one is taxes. So how much tax am I going to pay? I have this amount of money and land and property. The other part of it is administrative control. Like, what do I want to do with these things I have? So taxes and what do you want to do? These are the two things that we consider most important when you think of estate, right? And let's talk about estate tax. And you probably heard other name related to that. People also call it a death tax. Like if you die, you have these taxes. So they call that death tax. So let's understand it. Currently, it is 18% to 40% federal tax applied to the leftovers. Like you die, your estate has that, and that is, that value actually, the amount of taxes they charge you, it has a base. It's not like every penny you have. If you just have a $12 million right now, as we speak, and then you don't pay any estate taxes because it's under the threshold. But that threshold is different, literally by every president who come into the White House, they can re-establish that threshold. Okay. I know, like when we talk about $12 million in 2023, that sort of take away a lot of us, right? A lot of our small business people, and we didn't really have total of 12 million. And you may say that, oh yeah, Ying, I have 12 million, but I also have 8 million out of that is my mortgages. You know what? That 12 million is the value of everything you have, and your mortgage doesn't get deducted. So it is the value, it's the pure value of your estate. So you do want to know your 12 million, any penny more, 12.92 million, any penny more, you're going to end up paying taxes, right? And some state also charge estate taxes, but some state doesn't. And estate taxes and gift taxes come together. And the difference, someone was asking me, oh, Ying, when do I do estate tax? When do I do gift taxes? And, let me just say to you that you only do estate taxes after you die. But you can do gift taxes while you live, just because your gift taxes depends on whether you want to file them at the year you give out the gift. For example, you have a business, and our gift tax threshold is 15,000 a year for one parent to one children, right? Let's say, is that the case? 15,000. If you have a business, your business share is 15,000 per share. Then you want to file the gift taxes to make sure that you give that share to your children and you're underneath the tax gift tax threshold, so you don't pay gift taxes, right? And the reason I use share as example, because your business share could grow in value. You don't want to end up with the fact that when you die, your share value becomes so high, then you can't really give free so much like you can do it right now. So your share value might be $1 right now, but by the time you die, maybe that was $1 million a share. Then with your estate limitation, how much can you give to your kid? Not many shares. Then your business become, the ownership not going to pass on to the kids the way you're thinking. So there's a lot of detailed plan you can do, but I just want you to understand right here, right now, knowing that if you had a lot of money, the estate tax is a real issue for you. Of course, that is why we talk right now, right? We talk right now because you can plan to stay away from it. So estate inheritance taxes is the state one. So estate taxes, I was talking about the $12 million, that's the federal government. But at the state level, they have their own rules. So I kind of touched on the places we have branches as a community CPA. So Iowa does not have estate taxes and a gift tax, but it has what we call inheritance tax. It's from 5 to 10%. And then Minnesota has an estate tax. It is very low threshold, 3 million. So it's probably rich people should not die in Minnesota. I would just simply say that to you. And if you are in Minnesota, you know that $3 million and above, you pay Minnesota, estate tax, and it's 13 to 16%. That's quite a chunk. And the California taxes and Florida has no estate tax and no gift tax. It is actually maybe one of the reason, other than the weather is also good. Maybe that's one of the reason why a lot of wealthy people are living in those states. Does that make sense to you? So these things do drive where people go. And examples of estate on saving tax standpoint, and I have, a general example and a for example to avoid taxes. And you can, if you have a huge amount of 401k and those kind of money, if you pass on that to your kid, after you die, those chunk of money goes to your kid. Those assets will flow to your kids when you die, yes, but will be taxed when they withdraw it on the income tax. So there is a way you can do it to move this money into your business so your children can avoid paying taxes. So those are the things you have to plan ahead of time. And it's not something, you passed and then you go, my spouse will do that. It is not working in a lot of cases. And how is trust related to estate, right? So, we were talking about the tax side of things. I give you a glimpse of what could be saving your taxes. And in this slide on the bottom, I want you to see the federal side of the picture. And did you see that during the years from 2002 to 2010, okay, 8 years time, the estate tax exclusion amount was 1 million in 2002 and 1.5 million in 4, 5, 2 million in 2006 and 2008, and 3.5 million in 2009. And in 2027, it was 5.4 million. And in 2008 was 11.4 million. I say these numbers to you to impress you upon how that can change. So, yeah, we can plan for our death tax for 12.93 millions right now, because that's what it has. That's what we have right now in 2023. But just depends who is the president. That can change. So maybe you can slide back into Obama's president's time, so it will be lower. And then lower, if you die in those years, you're going to end up paying a lot more death tax if you don't plan. So that just to impress upon you that you need to plan. If you don't have anything, good for you. You don't need to plan. But if you worked your bottom off and made money and have this money for your children, for your family, and for your church and for your community, and you want to manage it, and there is a tax thing, then you want to plan it. That is what we're talking about. Trust is the tool to reduce your liability. okay, to reduce your income tax liability, and also a tool to manage your wealth, right? So how trust can help with estate, how trust can help with the land. Give me a second. So how trust would help with the land you left over after you die, right? So the trust can do the management for you, avoid probate. What is probate? We talk about that. We'll talk about that later. And probate, you avoid that, means that you take the government's hands out of your leftover. And you don't want your information to be on website for everybody to see. You want that to be privately dealt with. That is probate, publicly dealt with, and trust is a privately dealt with it. Can provide trust also can provide clear instruction how to divide your wealth, and can also let someone you trust to handle your afterlife. See how trust can do the management side. Trust can also set up routine review for you so that you can plan your tax liability, because you have a vehicle sitting there. You want to maintain it all the time. A lot of time, this is where folks coming in goes, oh, Ying, I don't know. I set up a trust. And do I set up with a attorney or I set up with a CPA firm? The trust itself need to set up by attorney, and it need to be a legal process. And the best way to set up your trust is to set up in a place where the legal service and the CPA service are offered at the same time. Let me tell you why. Trust is a document that changes all the time. And give you example, I have a client and they have 3 children. They did the trust about 5 years ago. And at that time, the children were perfect. So they have made their oldest as the trustee for the trust, means the administrator for the trust. So if the parents die, and actually in this case, it was a single dad. So if the dad die, the oldest will take over, will administrate the trust and divide things up. And 5 years later, obviously at our firm, and we update the trust together with your year-end tax return filing. So, we have you come back to do your taxes with us every year. And in that whole process, we update your trust. And at our firm, we have a team of attorneys can help with setting up the trust. So it is an internal process that we have. And this particular client, single dad with 3 kids, 5 years later, and he discovered the oldest was on drug. And with that, and when we prepare the taxes for him and his business, and we update the managers, the trustee, to be another child. And this oldest cannot handle these kind of family affairs. So you see how necessary that change needed. I also have another story to tell you. We have a client coming in. His mom and dad, and he's an older lady, his mom and dad set up this living trust. So dad finally died, so the trust become active. So she is she is the trustee. So she's ready to divide the house and the estate between her and her sister. And what happened is, when when she looked into the trust, she realized that the mom and dad never updated the younger sister. They are 7 years apart. So the mom and dad set up the trust and forgot about it. And then forgot about it, wasn't updated with a new baby girl. So this trust was actually ended up with just her without the younger sister. And then what's gonna happen? It is a lot more complex. So it's either the trust, and whatever the trust says, and a part of it will have to go to probate. Part of it stays in the trust. And, really depends. If she happened to be not getting along with the younger sister, I guess she can process the trust the way it is without the younger sister. The younger sister would have to figure something out, right? So I'm making a point to say that the trust is a living document. You need to update it, you need to control it, and you can direct your wheels inside of the trust. So that is a very important element why people want to establish a trust. And in 20 years ago, who established the trust? A much smaller group of people do. But nowadays, with the business growth in this country, with people becoming millionaire next day, we literally talk about people become millionaires next day. I see it. I have more than 10,000 clients. I see it a lot more than 20 years ago when I was in this same business. So nowadays, every day you have people make money, and this become a much more active issue than before. So you want to think about how to control and manage your trust. So with that said, let's look at what is inside of a living trust. Of course, there's different type of trust, right? No, living trust, it is a tool to help you manage your estate. It is a tool to help you manage and control your tax liabilities. And you can do planning upon that. And then this living trust, it is also can help you to make sure that when your family grows and your plan also change. So you don't want to set that in stone when you are still in your 30s, in your 40s. I always tell people that you do living trust in the 30s and the 40s, and you start doing a different trust, which is called irrevocable trust when you are in your 50s. And by the time you reach 70s, and you should not have any need to do trust because you are all set. So today, what I want to explain to you is why I say you should have a living trust in your 30s and 40s, or when your business is booming, you need to have that. Family living trust is the living trust I'm talking about. It's a central hub of your estate plan with provisions for managing, controlling, distributing your asset during life and after death. During life. Why I say during life? Because you change it. You can change it. If you discover your kids are not the kids you wanted, you can let them go. You can just take them out. You can do whatever you want because it's a living document. It is a document that you're in control, right? As part of that living trust, you actually have a schedule of asset. You have your business. You have your schedule of your business ownership. You have your final will. Like I say, final is not like you cannot change. You have your final will as of the end of today. Does that make sense? You can always change that. You also have this HIPAA authorization. What if you just become mentally ill? You can't make decision anymore. You want someone to be able to do that for you. So of course, you give a POA, you give a power of attorney for people who can help you. So those are all things that you can do when you have a living trust. So living trust is a legal document, it's a legal arrangement established by you during your lifetime. A revocable living trust is the trust I'm talking about. Revocable just means that you can change it all the time, right? And you can change it, and when you die, that living trust suddenly become you. Do things that you want. Okay, you don't have to worry about, oh, what if I put that in the trust? What's gonna happen? I cannot change that anymore. No, living trust is revocable trust. You can change it as you go. That's why when you do that with CPA in a CPA firm, what happened is because you visit that firm every year, you do your tax return with the firm every year. So you just, by the way, update your living trust so it will never go outdated. Situation like the other clients that I have would never happen. It's so ridiculous, right? You look at the living trust, goes, oh, the sister is not there. That is just not just the parent. They must be so busy with life. They can't really take care of everything. All right. So do I need a living trust? I think of the following scenarios to give you. Yes, I do. Yes, I do. If you have a health issue and your business is losing money right now and you want a living trust. If you are by yourself with no kids, and who is going to take over your money, you want a living trust. If you have a small house and 5 grown-up children, and you have one child is disabled, and you want a living trust, and you have a huge loan, and this is, there is a liability hanging on your back, and you want to have a living trust. So those are scenarios, and you want to know that you need a living trust. And I know you asked me about probate, so this is the probate, and the probate is including those kind of costs in there. The state charges you the probate. The cost of probate is 3 to 8% of the value of your asset. Let me explain to you. This is a real example. We have a farmer in Iowa, and the farmland, over 100-acre land. When he got the land from his dad, the land really was probably marketed at about $2,000 per acre. And now the land is at least 30,000 an acre that he has. So you can imagine the value change, right? So this value will be used to calculate your estate. That's the 3% to 8% over. It is not about what you bought for. It is what the market value is. Imagine if it is your house. You have $1 million house, but 800,000 is a loan. 200,000 is your equity, you call it. But that 3% is calculated on $1 million, not on your 200,000. This is why the next generation don't have money to pay the death tax. They sell a piece of land, or they have to sell the house to get the money to pay it. You don't want to put your kids in that situation. Then you want to avoid probate. So the living trust, revocable living trust, are not taxed every year like your 1040. But after you die, it is one-time return if you close out your estate soon. So depends on when you close it out, right? You may drag on for several years. You may drag on for 30 years like Jimmy, the musician. But normally you close within 12 months, then you file 1041. It is a return to file. But when you set up a living trust, there is no taxes for you to file. You just go for 1040. But the irrevocable trust is the one that file its own return. So that return is 1041. I wrote down here. So, it's not like you set up a trust. You're like, oh, Ying, okay, I set up a trust. How much taxes I have to file every year for this one? You don't need to. If it is a living trust, if it is revocable. Having a living trust, is it is your part of your tax planning, because when you have the living trust and you work it together with your annual tax filing, so we use that opportunity to actually update to see where you are. So that is actually a very good tools to have a living trust and be planned inside of your tax filing every year. So build a house to protect your estate. This house here is your living trust. You see, I said the family living trust, and you build this house, and I have details for you right here, what you would get through if you do a living trust with community CPA. These are the area of things, and we will get involved. The accountant will get involved with real estate side of things and making a list for you and know that what you own, the value, and business ownership, your bank statement, your bank investment, those are all coming in every year for your tax filing. So these are not anything new to you. These are things you already know, you already need to deal with. And the rest of the item, like the trust agreement, the attorney will take care of it. The last will and the personal property attorney and accountant will take care of it together. So with this combination of service, the team we have, and we actually can help you to build the house. But of course, if you have friends and if you have service providers are the same way, and you want to get that house built, you don't want to wait. And, in terms of building that house, and we, of course, you got the structure out, these 5 structures, then you want to furnish your house, right? Furnish your living trust. Furnish your house is literally a term they use. They say to fund, F-U-N-D, to fund your trust. So these are the 5 mix we have. We always tell our client about this. We tell our client that at Community CPA, we have 5 wealth mix. And we are actually saying to our client that if you want a balanced financial life, and you cannot just have one, and you cannot just have 2. You really need to have all these 5 balances: life insurance, real estate, and the 401k retirement funds, and the precious metals, literally owning the precious metals, and the stock market investment. Those are kind of things we say that you should have. You should fund that into your living trust. And the summary of benefit of having a living trust for a business owner: number 1, control over distribution of your worth, everything you have, and protect your asset. Protecting the owner's asset from creditors, lawsuit, and the probate court fees. Beneficiary will receive the asset more efficiently, quickly. Business can remain the same going forward. That asset protection piece has a lot to do with what kind of trust you are going to do. So these are the conversations when you come in. If you are asset protection focused, then you want to combine your trust work related to your tax structure. And I often saying to folks that, you also don't want to overdo it. A lot of times I do have a client overdoing it so much that she doesn't understand it. When you don't understand it, what built for you is useless. Just remember, you can only build a house that you can use. If you build a house with so many divisions and different sections you never even visit, you will forget. So it makes no sense for small business owners to make a huge plan on asset protection. I know you can go to Utah, sitting in those conference, and come back with like $35,000 paid, package, and for your business and your family. Overdoing it. My goal is not to make money on this. My goal is for you to be aware of what you can build. So build a house that just fit you. If you have a small family, build a condo. If you have a large family, build a single family home with 5 bedrooms. But there is no need to build a mansion. There is no need for all of my clients. My largest clients have an annual revenue close to $300 million a year. Okay, I don't have large clients, and my clients from 0 to $300 million a year. So what do you think? And we're not there. We're not there to build a mansion, but you want to have this trust build just fit you. So you want that to control your asset, protecting your asset. When you protect it and know that tax structure building is also very important. You combine these two, you'll be just fine. Privacy. That is why people build trust, privacy. So you don't have your stuff on the open court, right? Avoid probate charge. It's worth it. Your trustee, the one you appointed to handle your thing, they're not going to charge you 3 to 7%. And you can even literally tell them you do it for free, as long as is your directive. You need to control the situation and make that rules, right? And the last but not the least on this living trust setup for a business owner, because you can remain constant with your business. If you go through probate court, which I have gone through for one of our client, the husband is a physician, died suddenly, and the wife doesn't work, is a stay-home mom, and the husband died, so left the practice to sell. And it went, because there's no trust, so it went to probate court, and it took literally 3.5 years to sell the business. And by the time it sold, it was nothing. And so it is like really didn't help to keep that business running, because the business couldn't run normally, so lost the continuity and lost the client. But what if there is a proper control and proper plan, and if I die and the clinic can go to my the other physician who worked for me, what if that is that way? Then it will not have this kind of things happen, right? And that new physician who take over my place and can pay me for what amount the valuation is on that day of my death, and then the spouse would have money and things will be a lot better, right? So I just want to point that out because I see it. I know for our client, you're not sitting in my chair, so you don't meet so many people with all these issues. Feels like there's no issue because you have no friend having that issue, and you didn't know that could be an issue. So you are blind in that aspect. But if you're sitting on my chair, looking at the people that I have been talking to, I have so many appointments, right? That's why I write the book called Appointment with Ying. And all of these meetings taught me something, taught me if I don't know, I don't know. But if I knew, I really have the urgency to tell you that it is so important for you to make a plan. That famous slang in English, like two things happen for certain, death and paying taxes, right? But that paying taxes side of it, the death side of it requires a plan. If you want your life to continue without causing lawsuit, without causing someone, whenever they utter your name, they're like, you did not do your job. And we do have clients who would utter their parents' name by saying they could have done better. I feel so sad for the parents. And I happen to know their parents too. They are the second generation clients we have. So I see the parents. I know how they made money. And then when they pass on to the kids, they did not plan. So with that said, visit your living trust. Visit your house often and bring others too. So what I am saying here is that you want to visit your living trust very often. That's why I encourage you to do your living trust with CPA firms, CPA firm like Community CPA, because you go there every year. Just do it with someone that you visit regularly without planning. You have to pay taxes, right? So that is something like the government force you to see in every year. That part I'm grateful. If there's no taxes, there's no such thing about me anymore, right? So you need to tie your living trust to people like that, so you can visit there all the time, very often. After you created your estate plan, you create your trust, and make sure you communicate that to the affected party. If you named community CPA as your trustee, you need to tell community CPA, hey, you're my trustee. You know what? If I knew that when we purchased our liability, professional liability insurance, we purchased that piece for you. What if we did something wrong, right? So those are important things you communicate with the party that at the state. And once estate plan is in place, the trust is in place, you and your family should sit down and with the trustee, with the person, with the oldest, and to let them know the plan, right? And this discussion doesn't need to be doesn't need to say that, oh, I gave you this, I gave you this. No, no, no. What you do is you let them be aware. Just like Michael Jackson, after he died, his mom filed in the public court saying that he died without a will because he did not tell his mom he has a will. He should, right? You should. You should let people know. And this living trust need to be maintained. And the tax law also changes, and both federal and state changes. So you want to stay relevant with what you wrote there, right? Life also happens to us. Divorce, children got married. You happen don't like your daughter-in-law. Who knows? And maybe your daughter-in-law walked away and took your grandson, and who knows, right? Life happens. And have this place you visit every year to update these. Basically have a housekeeper who intimately understands your business need, can help you to keep up with the transition over years that happen in your trust. Find the right housekeeper, right? So this whole trust thing is giving a trust to someone. Yes, you're in control as long as you're on earth, but you are imagining you die tomorrow, so you give this trust to someone. And you want to find that right person. A lot of times our client would put their family members, like their cousins or the sister-in-law and whoever, give that to that person, and you want to communicate with that person. And it is very personal, and you must be able to trust that person and that company at all time. And we also have clients put on their children, but also put community CPA on there because they trust community CPA will be there when they die. And this is one thing that I also want to mention. When you do this kind of life plan, when you do your wealth management planning, you don't want to do it with one person shop. I can't tell you how many times the person died or the person just disappeared, and you will be clueless of what you have on your hand because you lost connection. And always look for businesses, look for the individual that will survive you. And you don't want to work with a person who are already 20 years more senior than you. What do you want? You want to get into your 50s, that person is no longer here, giving you more trouble. So no, in my own practice, in my own way of planning my own thing, I care about the person's age when I give everything to that person. Because if that person is much older than me, I can pick their brain. I know they have all the skills, but I want to make sure that the company would exist still without that person. Then I can rely on this company for a longer time. So sole practitioner is not a place to go when you do life planning. Just remember that whether they're lawyers or they're CPAs, as long as they're sole practitioner, and that should not be a place you go. And you must be able to trust that company when you work your life plan, right? It is important to identify a company rather just a person. That's what my point is. How do we operate as a housekeeper for you if you are doing living trust with community CPA? And we work with clients that we know for years. So if you just walk out of the street, oh, I just want my living trust. We do not normally do that. We only do our living trust clients when the clients are actually doing taxes with us regularly, because that is one of our promise to make sure that the trust is always relevant. We have the update on laws and regulation as part of our peer review process as a CPA firm, and you have these requirements. As the attorneys, they have their license requirements. So those are all a guarantee for the knowledge update. Unlimited file storage, that's what we have. We operate Community CPA from 1998. And do you realize that we have all of our files still with us from that very first day? And that is a kind of work I would be proud for my decision. I am the first one, when the professionals don't even trust the online storage, I already started doing online storage. So I always trusted the innovative ways for managing the storage, the documentation. So we have our storage for the longest time with Thomson Reuters, and our storage place is not outside of US. That is also one of the key elements when I work with my vendor, and I care where they put their things, because I want all of our clients to be safe in US. We never ever farmed even a number out of this country. A lot of CPA firms, even the big fours, they actually farm out their works to outside of US to get cheaper labor, and not at community CPA. We don't have cheaper labor here. Every one of us are elite, we are expensive, and we are professional. So that is how the ways we are doing. And we work to build those house, the living trust, with 5 years timeline. I say the 5 years, it is when you get into a habit. You need to get into a habit to know that, oh yes, I have a living trust. I just give birth to a new baby. The baby need to go into the living trust. So that habit takes 5 years to build. And what that means is we set up your living trust. The first time you come back to do your tax return, and we say, hey, let's do this planning for your living trust as well. Do you have a new baby? Did you buy something? Oh, you got another house? Let's update. Let's fund your living trust. That's what we do on a regular basis. And so this is a habit for you. And we actually, in our system, if you are our living trust client, we marked you differently. So we knew when to work with you to update that document. And we have so many years professional service experience behind us. We knew that when we say we are your good housekeeper, we are indeed one to help you going that life journey. So it's never pleasant to talk about what if I die tomorrow, but you see the news, people die very unexpectedly. So you don't want to wait until you experience that scare. Then you go, yeah, I want to get this trust done. And, of course that happens. We have clients, just gone through a tragic situation with, the couple got into a tragic situation, both nearly died. So they know that, oh, I cannot wait anymore. Ying, let's just get that in because I need it. I don't want to give my property to my uh, minor, still young kids. Then it's gonna fall into the parents-in-law's whole house, parents-in-law's hands, and that's not gonna work. So there's a lot of issues in our own home, and you want to manage that through a living trust. So I hope I give you a whole bunch of a reason why you need one, and you can think about it, sleep on it, and the key is I want you to take action. You definitely don't need to come to community CPA to do that. Go to your attorney, go to someone you see every year, all the time. And so that way you can get You can get your living trust done, and it doesn't take a whole lot. It just takes a determination. And I will definitely be here, answer your question. Remember this screen I showed you earlier? And if you go onto our website, you have these questions, and you can click one of us. And Dr. Howe and myself, and we are the two partners, don't have any free time listed on the website, but the other partners, they all have free 30 minutes. You can tap into their specialty and to be our client, to be under our care, and to hire us as your very good housekeeper. And this is our contact information if you want us to talk about other topics. And Catherine at communitycpa.com can offer you that. And like I said, we are 6 days a week CPA firm. And Monday to Saturday, we have 2 shifts. It's not like we're slave drivers making people work 6 days a week. And we have 2 shifts, people coming to work Tuesday to Saturday or Monday to Friday. So, oh, by the way, we are opening up Houston, Texas branch on June 1st of this year. So we will have number 5 branches after this. I will see you again, and I hope you enjoy the webinar, and I will continue showing up, and I want you to subscribe to our channel and like our videos, and that's an encouragement from your heart to ours, and I appreciate you. Bye-bye.